Ripple CEO Brad Garlinghouse recently launched a very public critique against Michael Saylor's aggressive corporate Bitcoin strategy. This attack is surprising because Garlinghouse is a massive proponent of the asset. He frequently calls Bitcoin digital gold and openly champions its role as a global store of value. His target is Michael Saylor, the executive who transformed his company, Strategy, formerly MicroStrategy, into one of the world's largest corporate buyers of Bitcoin. Why would a fiercely pro-Bitcoin executive attack the market's most aggressive buyer? This dispute is a warning sign. Everyday cryptocurrency investors are exposed to a hidden, systemic risk created by the specific methods these corporate giants use to acquire their assets. The core of the issue is a process called financial engineering. Strategy does not use its leftover corporate cash flows or software profits to buy cryptocurrency. This diagram shows their operation. They issue debt to stockpile Bitcoin, creating a feedback loop. Holding Bitcoin increases their valuation, allowing them to raise more debt. During a bull market, this leverage accelerates, generating massive gains on paper. While this mechanism builds incredible corporate holdings during a boom, it replaces a stable foundation of capital with a highly precarious tower of debt. Leverage works in both directions. The exact same mechanism that multiplies profits will ruthlessly accelerate losses the moment market sentiment reverses. This chart tracks Strategy's STRC preferred shares. Recently, they dropped significantly below their par value baseline. Trading below this line signals lost investor confidence, indicating the company's debt machinery is facing severe structural stress. Models built entirely on financial engineering create incredible hype when prices rise. But when that debt comes due, forced selling artificially worsens the market downturn for everyone else. This brings us to Ripple's alternative philosophy. Garlinghouse argues that long-term survival in the crypto space must come from real-world utility rather than debt-fueled hoarding. Ripple focuses its corporate resources on expanding cross-border payments, facilitating tokenized finance, and building blockchain infrastructure for large financial institutions. One strategy attempts to solve physical friction in global finance, while the other relies on complex borrowing to accumulate existing digital assets. Ripple's approach dictates that the cryptocurrency industry will only survive by integrating itself directly into everyday global commerce. The disagreement between Garlinghouse and Saylor highlights a tension between two distinct ways a company can interact with a digital asset, as a tool to be used or as an asset to be hoarded. If a highly leveraged corporate giant faces margin calls, demands from lenders to repay debt immediately during a sudden price drop, they are forced to liquidate their holdings. The sheer volume of that forced selling sends immediate shockwaves through the entire ecosystem. Because of this dynamic, checking the daily price of Bitcoin is no longer enough to measure the safety of the market. Investors must scrutinize the corporate balance sheets and specific debt structures of the companies holding these underlying assets. The risk here doesn't stem from a failure of the technology itself. It's a traditional financial vulnerability, billions in corporate debt that could destabilize the entire market if the price of the collateral drops far enough to trigger a collapse.